This stock used to be one of the biggest winners in fintech. Now, it's down massively from its highs, and most investors think the growth story has already peaked. But here's what doesn't make sense. My AI system just flagged it again. So the real question is this a broken fintech company or a mispriced opportunity hiding in plain sight? Today we're looking at Block Inc., ticker SQ. Block operates a full ecosystem across payments, small business tools, and consumer finance through Cash App. At one point, it was seen as a next-generation financial platform, combining payments, banking, and even exposure to digital assets like Bitcoin. But sentiment has completely shifted. Here's why the stock fell. First, growth has slowed compared to the pandemic boom when digital payments surged. Second, rising interest rates hurt fintech valuations across the board as investors moved away from high-growth names. And third, concerns around Cash App growth and monetization have created uncertainty about future revenue expansion. So right now, the market narrative is simple. Block is no longer a high-growth disruptor, it's just another fintech company. But this is where things get interesting. Instead of guessing, I run every stock through the same framework, the fallen growth valuation model. It breaks the business into three drivers: revenue growth, margins, and market multiple. Let's walk through Block using that model. First, revenue growth. Growth has slowed, but it hasn't stopped. Cash App continues to expand its user base, and Block's merchant ecosystem is still growing, especially among small and mid-sized businesses. The key question is whether growth re-accelerates or stays in a slower phase. Second, margins. Margins have been inconsistent, partly due to reinvestment and exposure to lower margin segments like Bitcoin transactions. But if Block improves efficiency and scales its higher margin services, there's room for margin expansion. This is one of the biggest levers for upside. Third, the multiple. Like most fintech stocks, Block's valuation compressed heavily when interest rates rose. The market stopped paying premium multiples for growth and started demanding profitability. So even without a collapse in the business, the stock still dropped significantly. Now, using those three drivers, we build scenarios. In the bear case, growth stays slow, margins don't improve much, and the market keeps a lower multiple on fintech. That would put SQ around $40 to $55. In the base case, growth stabilizes, margins gradually improve, and the multiple returns to a more balanced level. That puts the stock in the range of $70 to $95. But in the bull case, Cash App monetization accelerates, the merchant ecosystem scales, and fintech sentiment improves overall. If that happens, Block could trade back toward $120 to $150 plus over time. And here's the key. The market is currently pricing something closer to the lower end of those scenarios, but the AI model sees a higher probability of stabilization, not collapse. Now let's talk about what could actually move this stock. The biggest catalyst is margin expansion. If Block can show improving profitability in upcoming earnings reports, sentiment could shift quickly. Another major factor is interest rates. If rates begin to decline, fintech valuations typically expand, and Block would directly benefit. And finally, continued growth in Cash App engagement and monetization will be critical. That's the engine the market is watching most closely. So here's the verdict. Block falls into high risk, high reward. Accumulation on weakness. This is not a guaranteed turnaround, but it is exactly the type of setup where the market may be over-discounting future potential. This is what the market does. It overreacts to growth, and then overreacts to fear. And the real opportunity usually sits somewhere in between. I run this model every single day after market close. If you want to see what AI is flagging before Wall Street catches on, follow the Fallen Growth series.